the most tax efficient thing you can do is talk to an advisor early and often. As an acquirer, I want to see some compliance and I want to see some forward-looking thinking about how you've approached your taxes for me to feel comfortable with the business I'm buying.
What is one of the biggest mistakes founders make with their legal entity choice? They set it up and never revisit it, and it matters. Folks, I am delighted to welcome Dave Wanis, tax principal at Weaver, to talk with us about tax considerations for founders. This is a big topic, and there is a lot to cover, so we will break this down into a number of episodes. This is the first, and it focuses on tax considerations when choosing your legal entity to begin with. Let's get started. When launching a business, Dave, how should founders decide between forming an LLC, an S-Corp, C-Corp, and what are the most common mistakes you see at this stage?
Sure. Yeah, great question. It's an interesting question as well, because for the most part, any entrepreneur is going to start with an attorney and try to do the legal work first. So I always kind of love a question like this to start, because in my mind, when you see the word LLC, from a legal perspective, it's a very particular entity, but from a tax perspective, it is probably one of the most flexible entities you can have. And so I always like to say, rather than LLC as a tax concept, I would say a partnership or a sole proprietorship or some other type of flow through. And then I have a C corporation, and then I have an S corporation. But the LLC as a legal entity actually gives me the flexibility to choose any of those three. And each of those threes has their benefits and their drawbacks. And typically what you'll see is, in order to make a sort of final determination on the way you want this to be taxed, you have to give it some thought and anticipation. What are your expectations early? Do you expect losses? Do you expect to go profitable? Do you expect to need salaries? Do you expect this to be sort of more of an investment to decide how it's going to go, and then not really expect a big cash distribution going forward? Because each of those and each of those scenarios comes up with something a little bit different. Mm-hmm. And as a key example for that, I would say the one primary difference between some of these forms is the way self-employment taxes are treated. And when I'm working in a sole proprietorship or in a partnership, essentially 100% of that operating income is going to be subject to what we call self-employment tax, which is on top of your income tax. So some people might not be expecting that. They might be expecting just some operating income and some taxation on that. But to know that whatever income is generated will have this tack on taxes, some people haven't anticipated that and need to see where it comes from. Conversely, on the C corporation side, that's all done at the corporate level. So very big difference. Ultimately, it is going to come down to anticipation. It's going to come down to understanding where you want your business to be, and then understanding ultimately how you expect to exit.
Yeah. Dave, so proprietorships have to think about self-employment tax, correct? C-Corp gets treated like a corporation. Are S-Corps in the middle?
You're absolutely right. And let's talk about those three different scenarios, right? In all of these, we're kind of thinking about what you get paid as a salary. So the easiest example is C corporations. Probably a lot of people who are listening have been employees of a C corporation before. And every year they get a W-2, and on their W-2 is the amount of salary they earned. And then they see all these other boxes on their W-2 that have withholding taxes related to employment, related to FICA, related to FUTA, related to a lot of other employment type taxes. And that is a deduction against what they ultimately receive. Very simple construct. I get a salary, I get a W-2, and there's some withholding. Once I get into a flow-through structure, things change a lot. In the sole proprietorship or the partnership, now I'm not getting a W-2 anymore. I'm getting what we call a K-1, or even no documentation in the sole proprietorship. But all of that has to show up on your personal tax return as taxable income, and it's going to show up as both employment taxable base as well as income tax base. So very big number there. S-Corps are right in the middle. They say on one side of it, we'll act a little bit like an employer and withhold, some portion of your employment taxes. On the other side, you have to do what you would see on the corporate tax. So that's kind of the middle ground, but you also get taxed on the income that the business generates.
Are there mistakes to be avoided at an early stage when somebody's thinking about what kind of entity should this get treated as for tax purposes?
I think the biggest one I see typically is just people will come up with a strategy kind of on day one without really having thought through what a longer term looks like. I mean, obviously, no one can perfectly predict the path of an operation or what their exit is going to be. But, the biggest idea is think about it up front, revisit it soon. So I talked a little bit about the flexibility of an LLC. The nice thing about that entity is I can give myself 75 days and even longer if I need to decide how I want it treated. So if I'm actually planning, I can make certain tax elections to treat it however I want afterwards, which is a very powerful tool depending on some of these aspects we're talking about.
Okay.
I think the other biggest thing in my mind is people look at, especially small entrepreneurs, they look at that business in a vacuum and say, I live in Texas, or I live in New York, or I live in California. Every state treats these a little bit differently. So you want to at least have given some pre-thought to where's my market? If my market is in 50 states, I might choose a different strategy than I would if it's only in one or two.
From an operational tax consideration standpoint, once an entity is formed, what are some ongoing planning issues that entrepreneurs tend to overlook in those first years?
No, that's a great question. And, I work in a tax transactions area. So my primary job is to perform tax due diligence, primarily from a buy side. Meaning what I do is I go look at companies and I say, where do I see areas of risk? Where do I see areas of lost opportunity? And then I can advise my clients on both any inheritable risks that they might take on, as well as where there might be some synergies going forward. So I would say primarily from a risk standpoint, and we talked about this already a little bit, the number one risk in my mind is state taxes and what we call from a tax perspective nexus. And that just means having sufficient contact with the state that they might come knocking on your door or send you a letter and say, hey, I see you have sales here, or hey, I see you have an employee here. Why aren't you filing a return here? And that goes well beyond income taxes. There's also sales taxes, there's use taxes, and there's payroll taxes. All those things are things I look at as part of my diligence to understand if there's inherent risk in what you're doing. So if you're operating a business and you think, hey, I made a lot of profit last year, but you're not paying taxes somewhere, you might want to rethink what your projections look like.
Let's talk a little bit about compensation and distribution and how owners should think about paying themselves, be it as a salary or as a distribution. How does the choice of entity, shape the tax consequences from those decisions?
And we on a sole proprietorship or a partnership side, there's going to be all the income is going to be essentially allocated to the owners, irrespective of whether it's deemed salary or operating income. And all of it will be deemed pretty much as salary, meaning you're going to be subject to both income taxes on it as well as employment taxes on it. Very general rule. There's, some ins and outs on that can always be looked at to try to adjust a bit. But as a basic concept, it is probably the most taxed entity there would be from an individual standpoint. But on the flip side, if you're going to generate some losses in early years, maybe you can use some of those losses to offset other income that you have. The S-Corp, on the other hand, is a little bit different. Normally, an S-Corp will dedicate a salary amount, and they're actually required to dedicate a salary amount to the shareholders if they're performing services for the company.
Mm-hmm.
So that portion would be treated as salary, and the rest would be treated as operating income, but at least the operating income side would not be subject to an employment tax. Most of the time, what you'll hear when you're trying to decide between a partnership or a sole proprietorship and an S-Corp is the employment tax concept, meaning there are savings on the S corporation side for that.
I know we plan to discuss this next question in more detail in a future episode, but perhaps we can get in a little bit and just do a quick preview. If a founder knows that they may seek outside investors or eventually sell their company, how does entity choice affect future tax treatment, right? Particularly with incentives like Section 1202.
Mm-hmm. Great question. And I think 1202 is the one that I'll probably table mostly because it's an extremely complex provision. Everyone's hearing a lot about it. It's just been through the OBBBA rules, which are the new Big Beautiful Tax Bill Act rules. So there have been some changes to it, but incredibly important and effective. But it's something that deserves its own time on. Key to this is, again, a little bit of anticipation. What are your timing and what are your expectations? How long do you expect to sell or to hold the business or sell it or operate it forever? Are you planning on going public? Are you planning on staying private and turning it into a long-term business, maybe family operation? Are you going to sell to a third party? The form of the structure very much impacts what you see your exit as, because a longer term investment might have a different profile that you want to set up early than a shorter term one. And then from an investor standpoint, you really need to, and it all ties into that, who do you see your investors as? Now, I'll tell you, most investors, be it either venture capital or private equity or even the public markets or other sorts of forms, can accommodate flow through structures.
Mm-hmm.
That's a little bit of a change over the last, I would say, 10 to 15 years, because earlier it was everyone wanted a C corporation. But that is part of the equation. If you're expecting a private investment versus a public investment versus something else, the form of the entity will differ a little bit.
Got it. Final question has to do with tax efficiency strategies. What practical tax strategies can small business owners implement early on? Such as deductions or credits or structuring decisions to reduce the tax burden while staying compliant.
Yeah, and that's the trickiest thing. We talked about it a little bit in some of these other questions. I mean, number one in my mind is the most tax efficient thing you can do is talk to an advisor early and often.
Yeah.
If you're not talking to them, there's always going to be footfalls. It happens in every business. It doesn't, it's not your fault if it happens. It's just the way things operate. I mean, understandably, entrepreneurs are focused on developing the business model and building the business itself. Tax sometimes becomes sort of a secondhand strategy, but as an acquirer, I want to see some compliance and I want to see some forward-looking thinking about how you've approached your taxes for me to feel comfortable with the business I'm buying. And that can highly impact what your exit strategy is. So again, it's going to be, of course, businesses are complex, taxes are complex. There's a million things out there that can trip you up. So the idea is get someone talking to you early and often, and that way you can avoid them, because trying to remediate something is a lot worse than addressing it proactively.
Yeah. Dave, really appreciate it. This is a really important topic. We were never going to go through all the details. That was not the intention, but I appreciate you sharing with us some of your key nuggets. I hope to do more of these in the future with you for our listeners. We have a great set of episodes coming up that get into various topics that we've seen brought up in conferences and such as asset versus stock sale, such as the OBVA. So stay tuned for more of these episodes.